Paul Tudor Jones famously said, "Nothing good happens below the 200-day moving average." And we are sitting right on that knife edge at the moment. 4 weeks into the geopolitical strife, oil is well above $100 and inflation is reigniting. As for the Fed, they're caught between a rock and a hard place. Tighten and add to the misery, ease and repeat the 70s mistake of cutting into a supply shock. In the meantime, sentiment has deteriorated and breadth has collapsed. Only 19% of S&P stocks are above their 50-day moving average. But is this extreme enough? And do we have a turn? Not yet, we think. And talking of gold, many are surprised by the pullback. Our view has been that gold is a currency, not an asset, and as rates rise, all currencies weaken against the dollar, traditional haven or not, even gold is not immune. And while there is short-term downside risk to 4,200 for gold, higher volatility makes the buy the dip structures quite attractive. What to do with bonds? Spreads have no doubt widened up about 60 basis points from the lows for high yield, but remain expensive in a historical context. And duration is a risk. We have been and remain underweight. And that brings us to equities. Our proprietary market signals model is now in bearish territory. S&P and Nasdaq are both testing their 200-day moving averages. A bounce is possible from oversold levels, of course, but the risk that it's a dead cat bounce rather than a sustained reversal. But bearishness is relative, and US equities are positioned better than their international counterparts. All of this can, of course, turn on a dime, but for now, the risk and bias are to the downside. The one thing that is elevated, though, is volatility, and that is the opportunity. The knife edge cuts both ways. Position accordingly. This is Sunil Garg from Kenai and Lighthouse Canton.